Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us in this December Market Carver. So happy to have you along. We're going to go over a few of these things where we discussed in our Monday's allocation meeting, first one back from our Thanksgiving break. We're going to talk about the biotechnology sector and just a few points of analysis on it. We're going to talk about the country of India and really something to look out for in 2023 as a milestone they may reach in population. And then Andrew's going to cover what actually, believe it or not, has been falling volatility in the market. So we're going to start with biotech, which we would label as a subsector, a group of a broader sector, the healthcare, biotech, or companies that are involved in the development of drugs and pharmaceuticals and applications with the FDA, et cetera. So it's not a sector that we're always going to be invested in. It can be very volatile, especially for individual companies whose prospects could be gangbusters or bust, all based on FDA approvals or not. So just some points about this biotech sector that we think and find interesting for right now. First, we look at them in past recessions. There's only 3 individual examples here, so we don't want to make too much about it, what we would call as a sample size of 3. But we could see during the past 3 downturns, however, they both, in each of those, they held up very well relative to the overall market. So that's something to at least put in the back of our minds. Again, we would never put too much on 3 cycles, but those standouts make sense for 3 different reasons during a recessionary period. The first is that they often do well when you have FDA breakthroughs, and those aren't necessarily tied to the economy. A lot of other sectors are going to have some influence on the economic cycle, and whether we're going in an expansion or contraction is going to impact results. Of course, an FDA approval can come at any point during the cycle. That's point number 1. Why it makes sense right now to at least be on our radar is that there's a 33% increase from applications or projects on the FDA's doorsteps from these companies than there was just a few short years ago. So that is a sizable increase. And then next, there is an average of $2.6 billion and a 10 to 15 year commitment to bring a drug to trial. So in other words, just because we're getting ready to go into an economic slowdown, a lot of industries may change, may pull back, may make some cuts or changes. These projects go forward over a long period of time. So we do have in one or more of our models a very specific biotechnology holding, and we have had increased exposure to this sector here this year. This is one reason why it's going to stay on our radar, at least for the time being, and wanted to share with those with you as we found those interesting. Now, flipping the script here and going to India. So for centuries now, China has been the world's most populous country. Next year, I believe it is in April, where India is expected to overtake and actually become the most populous. So as China's population growth has slowed, India's is just beginning to accelerate or take off. And so just being the most populous country, not a reason to invest. However, it is worth noting that they are growing more rapidly. They are young and seeing productivity on the rise. And so these population by the UN here, by the way, is based on where the geographic lines are today. Those have shifted over time, but it is expected next year where India takes that mark that has been long held by China. So moving now to market and volatility, Andrew. I found this fascinating. You shared with us yesterday and really what we've been seeing in the market and what it might mean.
Yeah, for the last couple of weeks, we've been talking in our allocation meeting and trying to do our best to share some of these points in the market, Carver, are things we're wanting to see to start getting more confidence that the low that we saw back in October was possibly a solid low and that we continue to see the market move higher. One of those characteristics that we talk about, we often talk about breadth. We want to see a lot of stocks going higher, but what we want to actually see go lower is volatility. And what I mean by that is just the day-to-day fluctuations of the S&P 500. During the summer months and then the going into August, September, we saw a lot of really big up moves and a lot of really big down moves. And those are characteristics typically of a downtrend or a bear market. Some of the best performing days actually occur in downtrends. So we want to see a lot of that day-to-day volatility, those day-to-day swings begin to decrease and start seeing volatility come down. So the way we measure that is looking at, it's called the average true range, basically just a rolling number of highs and lows of just the market itself and kind of those daily swings. And we look at it over the last 3 months and over the last 1 month. This chart here is really long term, goes back to 2004. And you can see coming out of the financial crisis, that green and blue line on the bottom started to go down. After the 2018 kind of quick mini bear market, we saw volatility come down. And then same after we had the big volatility kind of or COVID crash in 2020, when the market started to rally and all that volatility started getting pulled out of the market, we saw the average true range, the day-to-day swings start to decrease. And that was one of the characteristics we really wanted to start seeing this year as well, to get confidence that buyers will return to the market. Part of the reason for that and why this is such a necessary component to seeing the market rally higher is institutional investors, the really big, heavy traders that really are driving the market from day to day, they determine their allocation size based off that volatility. So as it comes down, they can start increasing their allocations towards stocks. And that's what we're starting to see right now. That volatility started to decrease, and you're getting a little bit more confidence from buyers that they can increase allocations to equities because of it. So hopefully this will continue. We'll continue to see volatility decline, and that confidence can continue to increase. We'll of course watch this day to day, week to week, and something we're closely monitoring. But right now it's a good sign. We're seeing good development there, so we're happy to see it and happy to start reporting some good news after we've had a lot of bearish news this year in these weekly market carvers. It's nice to start reporting some good things that we're seeing develop in the financial market.
Yeah, little by little, and it was just a couple weeks ago. You began sharing a few bits and pieces of turning points and seasonality.
Yeah.
So little by little, starting to see the beginnings of the beginnings of what can hopefully continue. So thank you very much, and thank you all for giving us your time. Don't forget to come see us if you haven't seen us this year. We'd love to make sure to get your family update done. 800-928-4001 is the phone number. And if we haven't had the pleasure of working with you, by all means, give us a buzz and see if there's some way that we can work together and help you out. So thanks again and have a great weekend.